วัสดีครับผมอัธพลกิติอัครเสถียรวันนี้ผมจะมาขอแนะนำให้ทุกท่านได้รู้จักกับกองทุนเปิด TMBAM Eastspring Income Allocation ซึ่งเป็นกองทุนที่ TMBAM Eastspring ร่วมมือกับ Fund Manager ระดับโลกอย่าง M&G Investments กองทุนนี้เป็นกองทุนที่เน้นลงทุนในสินทรัพย์ที่ให้รายได้สูงเช่นพันธบัตรของรัฐบาลหุ้นกู้เอกชนหรือหุ้นที่ให้เงินปันผลผมขอแนะนำคุณไมเคิลไดเออร์ Investment Director จาก M&G Investments เพื่อให้ข้อมูลกองทุนนี้กับทุกท่านเพิ่มเติมนะครับ
Multi-asset investing's broad investment universe allows a couple of core advantages over investing in a single asset class for income. We don't have to put all our eggs in one basket. That means we can diversify from everything from government fixed income through to equities to build the most robust portfolio to deliver a growing income stream for our investors. Secondly, the world changes and we believe that your portfolio should change with the world. That means we can be dynamic in allocating between different asset classes to generate the most attractive risk return on a prospective basis. This allows us the flexibility to continually adjust and reallocate your portfolio to be the optimal that we believe it in any market environment. This is particularly important today as if we think about where markets are, yields on traditional income assets, whether it's fixed income or credit, are at record lows. We're seeing interest rates come lower, both in Europe and in the US. Equity dividend yields remain attractive. On the whole, the search for income requires a much broader scope than we've seen in the past, and that ability to look across different asset classes and think dynamically about where the most attractive opportunities are, we believe really gives the best opportunity set for today for multi-asset income. Why is this particularly important today? Well, with government yields at record lows and going even lower, equity markets somewhat volatile, the ability to be dynamic between asset classes has never been more important in thinking about how you deliver income to investors. We believe that in this current environment, multi-asset income has some distinct advantages over investing in a single income stream. And that income, as I mentioned, can be used for spending needs or can be reinvested and grown for total return. The income allocation strategy seeks to deliver a rising income stream and growing capital base for investors. We do this by actively managing the portfolio across different asset classes at our disposal. We seek to take an active view. We look for the most attractive income opportunities across whether it's government fixed income, investment grade credit, high yield credit, emerging markets, developed and emerging market equities. This broad range of asset classes allows us to flex the portfolio towards where we think the most attractive opportunities are. In doing that, we use a robust and repeatable investment process that's based on elements of behavioural finance. In essence, we're trying to find areas of the market where we believe the market has over or underreacted versus what's happening with fundamentals. Put simply, we're looking for places where the market has got too scared or too enthusiastic to either buy or sell investments at a reasonable price. We have a three-stage process to do that. First, we do a detailed valuation analysis of every asset class that we can possibly invest in, where we're trying to find what we think fair value for that asset class is. Firstly, we conduct in-depth valuation analysis. We look across each of the asset classes that we can invest in, and we try and determine a fair value for that asset class. We can then compare the current market price or the current yield on the market, whether that be income from coupons for bonds or dividends, a dividend yield from equities. We can compare those to the fair value and decide whether the market is cheap or expensive. And if it's cheap, obviously we'd like to buy a position in that market, and if it's expensive, obviously we would like to sell a position in that market. The second part of our investment process seeks to determine whether that price differential, whether it's expensive or cheap, is cheap for a reason or cheap because it's undervalued. And this is where we rely on some level of behavioural finance. The second phase of our investment process seeks to determine whether an asset class is cheap for a reason or cheap because it's attractive. To do this, we try and look at behavioural finance elements in the market to decide whether the market has got scared or overly enthusiastic about particular elements of the market. We're looking for areas where we believe we can understand what we call an episode for the market. This is where we believe that the market has become very focused on a single piece of news. So it might be about interest rates, or it might be about inflation, or it might be about trade wars. And because of that, it's ignoring other fundamentals which may be important. If we can understand why a market is cheap, and we think it's cheap and undervalued, then we'll purchase a position in it. Finally, the third part of our process seeks to put together the most robust portfolio of income generating assets that we can find. So here we're looking for balance between areas which we think will be a bit more defensive in nature and a bit more capital growth in nature. And we're trying to put them together into a portfolio that is targeting the most attractive income stream for you. So we'll hold equities, we'll hold fixed income, we'll hold emerging market debt. We put that together into a single package that we think is diversified across outcomes. We consider a market episode, as we call it, to have three core characteristics. First, it's characterized by a market which is focused on a particular news story at the expense of maybe other fundamentals which should be driving price but aren't. Secondly, we consider it to have rapid price action. So you might see an asset sell off very quickly, maybe 10% down, or rally very quickly. And thirdly, we expect that price action is to be inconsistent with the fundamentals that underlie it. So what we're really looking for by an episode is somewhere where the market has got ahead of itself in terms of either being too scared or too enthusiastic about particular asset classes' fundamentals. A good example of this came last year, if you remember, beginning of 2018. Equity markets entered the year very strongly and then sold off at the end of January through to beginning of February, particularly in the US. If you look at what drove that, there was a case of rising inflation, modestly rising inflation in the US, and the market went from being completely unconcerned about inflation to being quite worried about it. If inflation is rising, there's an expectation that the Federal Reserve might have to raise interest rates to combat that. Rising interest rates are negative for equities. What happened in early January was that fear, that change in market sentiment was exacerbated by technicals in the equity market, whereby people who'd sold volatility, who were betting on equity prices staying relatively consistent as they had done in 2017, all had to sell their investments and force the price down even further. So from an episodic point of view, or from a M&G investment point of view, looking at that, we could see that here was an asset class which had been too heavily sold by the market, that it had been seen to be very pessimistic, when in fact the change in fundamentals had been negligible. So we're able to purchase US equities at a relatively cheap price. They then subsequently rallied and rebounded. That's just one example. We see these episodes across markets, across the board at all particular times. In 2018, we also saw episodes in emerging markets in Turkey, in Mexico. We also continue to see episodes in areas like Italian bonds. So there's always something to do within the multi-asset income investment space, which is excellent for us as active managers. This is just one example of an episode that we saw in 2018. There are several others, including those in emerging markets in Turkey and Mexico, those in Italian bonds. We continue to see episodes across the investment universe at all times, at all parts of the cycle. And this is really why it's an attractive space to be an active allocator in, to be able to invest across different episodes in different markets at different times. If we think about today's market environment, it's interesting to think about where we came from in the last 9 or 10 months. Back at Christmas last year, we were expecting rising interest rates, potentially impinging on global growth, causing somewhat of a slowdown in a sell-off in equity markets. We went through a very strong rally in risk assets, and now we're at an easing cycle in markets. The Federal Reserve has started to cut rates and markets are expecting further cuts. This has pushed income or yields on government bonds particularly to record low levels. The US 10-year Treasury was at around about 3.2% this time last year. It's now below 1.5%. German government bonds have been negative across the yield curve, so right out to 30 years, for a number of months now. This creates an interesting environment to be an income investor. To have to think more laterally about opportunities in terms of finding attractive investments for the portfolio. Now, I think the global market sentiment at the moment is relatively pessimistic. We'd actually say that we think it's perhaps overblown. There's plenty of investment opportunities out there which we think are attractive. If we think about where we'd rather be in terms of equity versus fixed income, equity markets have been quite suppressed more recently. And that's helped us find attractive valuations both in Europe, in Japan and in the US to invest where there's very attractive dividend yields at very attractive valuations. In particular, we find banks in the US and Europe attractive from a yield perspective. If we turn our attention to credit markets, right now we're at one of our lower weights in terms of corporate credit. We believe that at this late stage in the cycle, we'd rather be investing in those equities that I just mentioned for yield rather than in credit. Instead, we'd rather be in fixed income markets, we'd rather be invested in some of the more peripheral European markets, such as Italy for attractive income, in emerging markets for income. And then for defensive assets in the portfolio, we continue to still hold positions in US Treasuries, particularly at the long end of the curve. This provides some level of risk offset between our long equity positions and our fixed income positions. So all in all, we're trying to provide a well-rounded, diversified investment portfolio which we think is well suited to the next phase of the cycle. If we think about the global environment today, it's interesting to think about where we've come from in the last 10 to 12 months. We've come from an interest rate rising cycle into one where interest rates are now falling. If I think about where the market is today, it's also interesting to think where the market has come from in the last 10 to 12 months. We've moved from 10 months ago an interest rate rising cycle to today where we're looking at global interest rates largely being cut, whether that's in the US as the Federal Reserve has peaked and is now cutting rates, whether that's more stimulus from the ECB in Europe. We've seen the US Treasury market trade from above 3% for the US 10-year down to below 1.5% now. The German government market is trading negative across the whole yield curve. Equity markets have been volatile, quite sentiment driven, depending on what's happening with the latest on trade wars and developments there. All in all, we've seen a lot of price action this year, which was relevant to whether we think as episodic behavior. This is providing attractive investment opportunities for us, even though rates are quite low. So today, we take a rather more optimistic view of the market. We think the market has become very pessimistic and a lot of stuff is priced in already. So we're willing to take risk in areas such as equities. We think equities in Europe, in the US and in Japan are attractive. In particular, we think banks in those areas provide very attractive dividend yields at very attractive valuations. In fixed income, we think areas of the market such as Germany and the UK are very expensive, but we do like areas such as Italy in Europe. We also like emerging market debt for yield, particularly high carry. We prefer those over credit. We think at this stage and late in the cycle, it's better to be an equity holder rather than a credit holder, so credit's at a relatively low weight in our portfolio. In fixed income, we hold a combination of government bonds and emerging market debt and a relatively low weight in credit. In government bonds, we have some positions in US government bonds, which we think provide diversification versus the equity part of our portfolio, should global growth disappoint. But really the yield is coming from peripheral European bonds such as Italian bonds, Italian BTPs, also from emerging market debt. And we have a relatively low weight in credit today as we prefer to be an equity holder rather than a credit holder in this market environment. So all in all, we have a modestly positive view of the world. We like equity, we continue to hold some high yielding fixed income, and together we think that provides a great opportunity to deliver both income stream and capital growth to provide a rising total return for our investors overall.